I did, and when I report to shareholders, I want to use straight line because that might make depreciation less early on. It might make my profits look better. I want to make my profits look really good for shareholders. But when I'm actually analyzing this stuff, I want to know exactly how my taxes are going to be affected for real. Like, what am I really going to pay? And that is determined by IRS rules. And the IRS mandates that any firm in the US, when they depreciate an asset and they're trying to figure out their tax liability, they use what's called MAKER's depreciation, Modified Accelerated Cost Recovery System. It's a mouthful, right? So we use that in capital budgeting because it's going to tell us exactly how much tax we can expect to pay on something, right? That's the reason why. You never use straight line in a capital budgeting analysis or double declining balance or any of those other systems. You only ever use MAKER's because that's the one that affects your tax bill, right? So MAKER's, as is specified by the IRS, they determine this stuff, okay? And MAKER's will have assets split into different categories. And you can see here, right? 3 years of depreciation, 5 years of depreciation, 10 years, right? And you can kind of see in general what you're talking about here. It looks like short-term assets and longer-term assets, right? And so the IRS isn't going to ask you, like, what's the lifespan of this asset? They're going to, like, what is the asset? And you see what category it goes in. And once you see that, you know how you depreciate it. So something to keep in mind, you could have a 5-year project, like your truck for the lawn care business. You might only have that for 4 years, but maybe that truck's gonna be depreciated over 5 years. Like, could you have depreciation for 5 years even though it's only a 4-year business? Yeah. That means the 5th year, you won't need to worry about that depreciation. It's not gonna be relevant, okay? Keep that in mind. Depreciation will not necessarily match up the lifespan of the business. It's matched to the assets you acquire for your business. They don't just define that, they define the rates per year. So let's go another page over. So for example, if you had something that's going to be a, let's see, what do we say, a truck? So the lawn care business, it's going to probably be a 5-year class of asset. That means in the first year, we're going to depreciate 20% of the initial cost of that truck. I'm buying a $50,000 truck, so 20% is 10 grand. 10% or 10 grand is going to be my depreciation for year one. Right? So I could say initial cost, let's see, my cost, 50 grand. My year one depreciation rate, 20%. So my depreciation in dollars for year one, 10 grand. My accumulated depreciation, just 10 grand. What about year two? A year is it, we've advanced a year. I'm going to add a couple more columns over here in a second, okay? So I'm going to add a couple more. But second year, I still paid 50 for that truck, but in year two, I depreciate 32%. So now, 32%, that's going to be 16 grand of depreciation that year. So a total depreciation of 26 grand, right? And you can see how this is going to go. I could do year three, it's still a 50,000. It still cost me 50 grand back when I bought it. I'm going to do 19.2% in that year. So that's going to be $9,600 of depreciation in year three. And that is $35,600 total depreciation over the first 3 years. So that's how that's going to work. Let me add in one or two more columns here. So what else might I want? I need to know the book value of my asset. So like I said, the book value is the initial cost less my accumulated depreciation. So 50 less 10 is going to be 40 grand here. 50 less 26 is going to be 24,000 in year 2, and then it's going to be 15,000 in year 3. We're going to use that. It's going to be a very small piece of our analysis, but it's going to be the thing that's going to be the busiest amount of work to get there, okay? Now, real quick, what if I just needed that number right there? What if that's all that I needed in that table? Do I need to build this whole blasted thing for it? Here's a shortcut. If I want to know the book value in year 3, here's my shortcut. I know that it's going to be my cost. So I know that's 50,000 minus my accumulated depreciation. But here's the easy way to get that number right here. Take my accumulated depreciation in percent terms times my cost. And my cost is that 50K. How much depreciation have I rung up after 3 years? All that summed up, right? 20% plus 32 plus 19.2. So what was that? 50, 60, 70, 71.2? Does that look right? 71.2%. So we'll do that. 71.2 times 50,000, and that should give me 35.6. That's the quick way. Don't go through the whole table if you don't need to. Just add up the depreciation rates per year, multiply that by your initial cost. That's how much depreciation you've accumulated. Subtract that out of your initial cost, you've got your book value, okay? So, but that's where the numbers come from, okay? So keep that in mind. We'll always use Maker's depreciation for capital budgeting analysis because that gives us a true tax picture, which we need. We're not reporting this to shareholders, by the way. This is internal stuff in the firm. This doesn't get reported, right? They'll make a press announcement, but this is for us to determine do we do the project or not. So we have to be as precise as we can. All right, let's see. Let's go and do another problem. Let's look at 13.3, net salvage value. That's where this stuff's going to come into play, okay? So the net salvage value is this. At the end of the project, we're going to have the whole equation. We're looking at one piece. When you sell off that CapEx, those assets you bought, my truck and trailer and lawnmower, you know, I paid 50 grand for it, right? After 4 years, I'm going to sell it in the market, but I'm estimating what I think today, what I think I'm going to sell it for in 4 years. That's called a salvage value. Alternatively, you could say expected market value. That's what salvage value is. It's an expected or future market value. It's probably the most uncertain thing in our analysis, right? If you buy a car today, what's it going to be worth in 4 years? But you need to you need to estimate it, right? You need to estimate what you think it's going to be worth. And then you may have to pay taxes on that. So here's what we're going to do. After tax salvage value, it's going to be ATSV, after tax salvage value. It's going to be our salvage value, what we think we're going to get when we sell this equipment, minus any taxes. That's fair enough, that's simple. Here's how we get the taxes. We're not going to do like NOPAT. We're not going to take salvage value times 1 minus our tax rate. We don't do that. Here's what we do. We take our salvage value less our book value times our tax rate. We're going to do that problem in a second. Let's go back over here. After 3 years, I was pretty good. I got out of college in 30 years instead of 4. So I sold my business then, right? My truck and equipment are worth 15 grand. I paid 50 when I started college, but they're now worth 15 grand. But I'm able to sell it for 25 grand to one of you guys. Do I pay tax on 25 grand? No, I pay tax on the difference between them because that's my profit on the transaction. Right, so I already paid 50 grand for this asset. I've depreciated it down to 15. but I get 25 in selling it to you, so I got to pay tax on that difference, how much I gain. So that's how it's going to work. So let's go work at this 13.3 up here. It says Allen Air must liquidate some equipment that is being replaced. The equipment originally cost $12 million. Okay, so let's see. 12 million is the initial cost, right there, of which 75% has been depreciated. We get accumulated depreciation. Take the total in percentage terms times the cost. That's 9 million's been depreciated out of 12. That's going to leave us a book value of $3 million. That's the book value for the asset. Okay? What we initially paid, 12, minus the depreciation, which is 75% of that. So 3 million there. What else do they tell us? The used equipment can be sold today for 4 million. That's the salvage value. So we're selling this, we're going to get 4. I'm going to sell it to one of you guys for 4 million, but then I report to the IRS and say, I sold it for $1 million above my book value, and they're going to tax me in that $1 million gain, okay? And my tax rate's 40%. So I'm going to get 4 million selling this. I'm going to pay the IRS $400,000. That's going to be 3.6 million is how much I net between those two different things, right? What I got when I sold this equipment, less what I had to pay to the IRS in taxes, 3.6 million. All right, we've gotten our feet wet. Let's go take on the big one now. Let's go to the mini case, and let's look at it. All right, back here. We're not going to do all of this. We're gonna work this problem today. We're going to do the math on it, get all the cash flows for each year. We're going to compute a net present value and an IR, see if it's good or bad. Okay? We're going to do the whole analysis. But then this chapter actually is really 2 chapters thrown together. The first part that we're doing today is estimating the cash flows. All right? And then applying what we did the past chapter, NPV, all the different rules, is a good or bad project. The other half of the chapter is like Jekyll and Hyde. The other half of the chapter is looking at project risk, which is something you haven't probably been talking about or thought about when you do capital budgeting projects, but we already have an idea. Riskier projects should have a higher required return, right? Remember that? Like it's not just divisions, but even projects, if they're riskier, they have a higher hurdle rate to get over, and if they're less risky, a lower hurdle rate. So we need to think about, that's one way to adjust for risk, is the discount rate. There are other ways to adjust for risk, to account for it. We'll do that on Tuesday, right? So we'll look at project risk then. And we'll come back to this case and see how to implement those various ways of dealing with project risk using the mini case data. Let's see what we have up here, okay? So, in fact, see what I may do. Let's do this. Let me go over to the document camera. I think this will let me. I'm doing this because it's easier for me to mark this stuff up here. It's actually already marked up. Probably should have brought a fresh copy, but so here we go. Here's our data in here. All right, so let's look at what we've got. I want to set up, so first thing, what do I want to do? I want to know how many cash flows I've got in this project, right? So it says, let's see, this has an economic life of 4 years, machinery salvage value after 4 years, incremental sales per year for 4, it looks like it's a 4-year project. So I'm gonna have 5 cash flows, right? So 4 years plus the initial outlay. So we're gonna set all this up here on the board and work through it. Now, I'll go ahead and tell you right now, if you read through the entire narrative, we've got 2 paragraphs here. They mention inflation. So for today, we're going to leave inflation out. We're going to come back and add that back in later, right? But for today, I think we're just going to leave inflation out, like it doesn't exist in this problem. All right, so let's see. I need to set this up. Let's see. So we're going to have year 0. I'm going to do this where each column is going to be a year. And so at the bottom of the column is going to be free cash flow. Okay? So instead of doing horizontal, it's just going to be done vertical. Let's put up here at the top my revenue. We'll go here. Let's get the next year. We'll flesh it out and get all the other years in a bit. Okay? I need my revenue, operating expenses, and so forth. Let's see what we've got. Let's see. We're adding a new line to our product mix, right? So a new product is going to be up here. Let's see. We're going to use some unused space in our plant. We've got some equipment we're going to buy. It's going to cost $200,000 plus another $10,000 for shipping and another $30,000 for installation. This is something I didn't tell you guys before. Like my truck for my landscaping business, it didn't cost me $50,000. It cost me $45,000, but it was I had to have certain things done to it so I could, get in and out of the places I'm going to do lawn care, and that cost me another $5,000 modifications, or $3,000 modifications. It was a truck that was over on the West Coast, and they had to have it shipped over, and that cost me another $2,000 for delivery. See what I'm getting at? It's my all-in cost. It's the base asset plus any modifications, any installation, any delivery. All of that is going to be part of my initial cost that I will depreciate over time. So it's not 200, it's 200 plus 10,000 plus 30,000. Shipped, modified, installed cost. All of those things go in on this, okay? So 240 grand is going to be that. So let's just put over here as a quick note. My CapEx is 240, and that is my initial cost. That's what I'm going to be depreciating, is the 240, okay? Let's see what else we have up here. They tell us machinery has an economic life of 4 years. We're going to use the maker's 3-year class, okay? Salvage value $25,000 after 4 years. So salvage value, 25 grand. Let's see. New line should generate incremental sales of 1,250 units per year for 4 years. So they gave me Q, 1,250, at a cost, that's the variable cost per unit, a cost of 100, and sold at a price of 200. So my price, 200, and my variable cost, 100. Again, they talk about inflation. We're going to ignore that, so just make inflation 0 for today. Let's see, working capital will have to be increased by an amount equal to 12% of sales. That's different. The other had a fixed amount, right? This one is attached to sales. So if sales goes up or down, working capital will move with it. So working capital will be 12% of our sales. And in fact, we're going to make this assumption. We're going to say that our working capital in year T is going to be a function of our sales in year T plus 1. I need the working capital in place before I implement the sales, okay? So we'll do that. And so it will be sales T plus 1 times 12%. We've got a tax rate of 40% and a cost to capital of 10. And then they give us a bunch of other stuff. Basically, they're telling us to have at it. We've got everything we need. Okay? So let's see. Let's put up what we know. Revenue minus operating expenses minus depreciation gives us EBIT. Minus tax gives us NOPAT. And then what do? We have our CapEx and our working capital investment. We make adjustments for that, and we've got our free cash flow. Same equation, but just it's almost like a financial statement instead of like the equation form, right? That's all I've done. Okay, let's work out what we can over here. So we're going to do revenue should be price times quantity. $200 a unit times 1,250 units. So that's $250,000 in revenue. So there's our revenue, $250,000. Remember, not at time 0, that's when we're buying our equipment, right? That starts in year 1. And we're going to have that in year 2. For this problem, we're saying we're having the same revenue each year. When we come back and redo this really quick on Tuesday, we'll have inflation, and inflation will make revenue higher each year because of price increases. What else could make revenue higher each year? Sell more stuff, right? Yeah, so you could have higher revenue because of inflation and or because of growth in sales, right? We're gonna have flat sales every year. We're making this as simple as possible. We're having flat sales every year and I'm taking inflation out, so none of that. So revenue's the same. It's not quite realistic, but we just want to get the basic idea of putting the stuff together for right now. Then we'll augment it on Tuesday to make it more realistic, okay? So there's that. Our operating expenses. So variable cost, right? This is our variable stuff. I didn't see any fixed cost up here, so that's 0, okay? So here, we've got 100 a unit times 1,250 units. That is $125,000. So there's those. So 125. Again, if I actually sold more units every year, that's going to go up, right? Variable cost. If inflation hits us, which we're ignoring today, that could make it go up too. So that's the reason it's just going to stay flat every year because of what we're doing, because of our assumptions. Yeah. Okay, now the one that's a bit of a pain. Let's get depreciation real quick. So for this thing, I'm not going to do them precisely the way they do in the appendix for the chapter. Let's see, year 1, 2, 3, and 4. I've got my cost, and that is the installed, shipped, delivered cost of that equipment, the $240,000. I mean, my depreciation rate is 33% in the first year, 45, 15, and then 7% in the last year. So now I'm just gonna go and multiply across. That's gonna give me my dollar depreciation. That's what's gonna go in my table up here. So that is year one, 79.2. $108 for year two there. Let's see. 36,000 in year three. And then 16.8 in year four. And you should, since we're depreciating it over 4 years, and this adds up to 100%, fully depreciated. If you added this column up right here, you should get the same 240 you started with, which means you fully depreciated the asset after 4 years, okay? Year one depreciation, year two, year three, year four. That's gonna go in my table up here. So 79.2, 108, 36,000, and then 16.8. Right? Okay, so that gives us EBIT in year one of 45.8. Our taxes, they say, are 40%. So take 40% of that. 18,320. And subtract that out. And we get our NOPAT. So 27,480. I'm going to leave CapEx and OWC blank for the moment. Okay? Leave those blank. We'll come back and get them. And we do the same thing for these guys here. That's 17,000 of EBIT there. Taxes on that are 6,800. That gives us 10,200 in NOPAT for year two. There's our NOPAT for year three, and then let's see, go for the last year. Okay, so we've got the big ticket items out of the way, right there. Let's see, what's revenue going to be at time zero? Zero. It's going to be zero, right? I need to mention that because every time the assignment in this one, I see a few pop in revenue there. Not at time zero, right? Operating expenses, none. Depreciation, none. EBIT, tax, all zero. NOPAT, zero. Okay? Not until year one. So we're going to have it at time zero. Our equipment, right? The 240. That number we were depreciating is going to come in right here. Now, in the equation, in the bracket, that was a positive, but outside the equation, we have a negative sign. So I'll just go put that negative right there, right? Because we know that's an actual cash outflow. What I want here are the cash flows. Let's see. Let's get our working capital. Let's see. I'm not doing more CapEx here, here, or here. But I'm going to liquidate. I'm going to salvage this thing in the last year. Let's get our after-tax salvage value. This is going to be our ATSV right here. So it said salvage value 25,000. Okay. So that is going to be 25K let's see, after year 4, what's our book value going to be? Well, let's see. Accumulated depreciation in year 4 will be the sum of all that, 100%, times our cost, 240. So that is 240,000 accumulated depreciation after 4 years. So the book value in year 4 is the cost minus the accumulated depreciation. It's 240 minus 240. It doesn't have any book value. We've completely depreciated it. So all the 25,000 is profit. We're going to pay 40% tax on that entire amount. So I get 25 selling this, but then I pay 10,000 to the IRS. So the difference is 15 grand. Inflow, right? Inflow, because we sold the asset. That's how much we have after paying the IRS their 10. Almost there. What do we have to do now? Working capital. What's working capital? Here, 12% of that number there, right? 12% of next year's sales. $250,000 in sales, 12%, what's that going to be? 30,000? That's going to be an outflow as well. And let's see. Now we've got to be careful here. Let me put an extra line down here. This isn't part of our cash flows. Just put it down here at the bottom. NOWC. See the difference, right? Level change. So before the project, NOWC is 0. But if we do this, it's going to go to 30 grand. That's an increase of 30. That's going to be an outflow. What's our NOWC going to be in year 1? It's going to be 12% of that, which is going to be another 30,000. What's the change? 0. So that means our investment working capital, or the increase here, is 0. No increase in working capital. Right? In other words, you might have to compute working capital and then each year and see how much is changing, and that's what goes in, is the change. Let's see, 12% of that number is 30,000. But we're already at 30, so there's no increase or decrease. So no change. Year 3, 12% of year 4's revenue is 30,000. That's what we had in working capital. So you see what's going on here, right? So there's no change. We keep our working capital at 30,000. We're using it up, but we're replenishing it. We're keeping it at the same level. It's like a bucket of water. It's got a spout. It pours some out. We pour another spout with water coming in at the same rate, so it stays level. We use up a bag of fertilizer every day. We add another one into our warehouse. That's what's going on. Okay. But let's see. We get to the last year, and you say 12% of there's nothing here. 12% of nothing has got to be nothing. So we don't need any working capital here, right? I don't need any at the end of the project. I don't have to keep replenishing my gasoline and fertilizer if it's my last year. I'll let it run down. And that's freeing up money. When you let your working capital draw down, it's the same thing as having cash flow come in. So that means the change from 30 down to 0, we reduce it by 30. A decrease in assets is an increase in cash. So that's going to give us a positive 30 right there. We sometimes call this recovery of working capital. Okay? Got one step left. Let's just add everything up. 270, 27,480, 10,2. And then this one, let's see, what do we have? 9109. 120, something like that. And we're going to use a 10% discount rate on this project. Let's see if this project's any good. Let's get out the calculator here, and let's see what we got. Okay, cash flows. Clear that out. Initial 270 negative. That's my first cash flow. Let's see, 27,480, enter 10.2, 53.4, 109,920. Because my cash flows are all in. I want the NPV, so 10% is my discount rate. Let's compute the thing. Negative 121,391. Not a good project, right? So we would reject this one. What's the IRR going to be? What do we know? What do we know is going to happen with the IRR? It's going to be lower than the cost of capital, right? Let's go compute it. Compute, and we get, actually we don't just get lower, we get a negative IRR. This has a negative expected return. So it could have been a positive return, just lower than the cost of capital, but it's actually a negative return. So this is an awful project, right? That's decidedly below 10% by quite a way. So we wouldn't want to do this project. It might turn out, when we get back in here on Tuesday, when I update it to add in inflation, it might be a good project. We may even do some other augmentation on it too. We've got about 5 minutes. Let's take that and let's go over some of the things we skipped that were in some, like we didn't finish up all the problems. So let's add in some issues, or we'll talk about some issues here. Let's go back up. Let's go to those first couple of problems. Okay, let me get a concept out of the way before we answer. This is at 13.1. We skipped B and C. Okay, we spent $150,000 in R&D about that project. Right? Where does that 150 go? We didn't deal with it. Does that go in there? And then C, it says, rather than build a new manufacturing facility, the company plans to install the equipment in the building it owns but is not now using, which could be sold for $1.5 million after tax. How does that affect things? Or does it? So let me give you a term real quick before we answer any of that stuff. That's what we're dealing with, incremental cash flow. What does that mean? I don't need to know all the cash flows we're already generating in our business. I only need to know the cash flow, how the cash flows would change if we do the project, which means I only need to know the project cash flows. Put differently, let me rephrase that. How would things be different if we implement the project? That's incremental. What would the changes be? And that's all you need in your analysis. That's all you need, okay? So, we spent an expense. A better term would be, that's accounting. We spent and we paid, and we cannot get back the $150,000 on research. Now, incremental means if we do the project, this occurs. If we don't do the project, it doesn't occur. See what I mean? So it's a definite, the project changes things. If we don't do that project there, will we get the money back? It's spent, right? We had to pay some firm to do the research. We owe them that bill whether we do the project or not. That is not an incremental cash flow. It is not in the analysis, that 150. There's a term for it, though, that you guys have heard before. You know what it's called? It starts with an S.
Sunk cost.
Bingo, it's a sunk cost. So that money already spent that we can't get back whether we do the project or not, we refer to it as a sunk cost, but alternatively you can say it's not an incremental cash flow. Because if you say yes or no in the project, will not change that money being spent. It will not change it. So you leave it out. It's irrelevant. Now C, we could sell, let's see, rather than build a new manufacturing facility, we will install the equipment in a building we already own but not using. Alternatively, we could sell that building for 1.5 after tax. I do the project, I don't get the 1.5 million, but we implement the project. I don't do the project, we sell this facility for 1.5 million. Is that incremental? Yeah. You can see how things are changing depending on our accept reject decision. That 1.5 million has to be included. That's going to be referred to as an opportunity cost. You have something, it has an alternative use. The value of that alternative use is 1.5 million. We can use it in our project. It looks like a freebie. A lot of people would include it at zero cost in the project. But it's not zero because we can earn 1.5 million selling it today. So how does that get included in your analysis? If that was this project we just did, here's what I would do. Somewhere in here that says after tax, I would say asset sale. Hey, it's another CapEx. I can sell this thing for 1.5 million after tax, inflow, right? Because we're getting that. Oops, I'm sorry. It's not going to be an inflow, is it? Because I'm giving it up. So, opportunity cost. That really is going to look like an awful project now. Right? But what if that had been a big positive NPV? That could have made it negative, right? So you have to consider the alternative use of assets. If you deem them to be incremental and they have an alternative use, what was that value that you're giving up? That becomes an expense in your project. That's what that's getting at. Last one, let's go down to the mini case real quick. No. Let's use 3.2. What did we not use in this problem? Interest expense, right? We're computing free cash flow, right? And what do we say about free cash flow? It can be used to pay shareholders dividends, stock buybacks, park money in operating assets, or pay creditors what you owe in the loan balance, or interest. You don't include interest in a capital budgeting analysis, even if you incur it in a project, because that's a use of cash flow, and that's what we're computing. See what I'm getting at? It can be used to pay that interest. You don't take it out of cash flow. You get the project cash flows, you say, this could then be used to pay interest, or loan principal, or dividends to shareholders. If you said, oh, we're going to pay out $1 million in dividends a year, that's great, that's not part of our analysis. That's a use of cash flow, right? It's not a source of cash flow. So that's why. If it's a use of cash flow, it does not go in the analysis. If you say, we're going to take all this money and buy short-term T-bills, fantastic. Do not include that in the analysis. That's a use of cash flow. So all the uses of cash flow are not included in there, okay? Just the sources, the operating stuff and the investment stuff is included. That's it. And the opportunity cost, right, but not the sunk cost. There's one more. I'll show it to you on Tuesday. We'll come back and do this problem again with inflation in it and mess a few things around, and then we'll start looking at risk with the same problem.